Here's Boris in Richmond Hill, Ontario. Hi, Boris.
Hi, thanks for taking my call.
You're welcome.
My question is about Goldman Sachs. Do you like it at this price? How do you see it in a year? And also, if it doesn't play the way you want to, how do you protect yourself on the way down? Thanks.
Okay. So Boris, that's a great question. Goldman Sachs, has been a really well-managed company for a long time. And certainly it's in the right group. If you look at financials as a group, they are one of the strongest performing parts of the market. Within the financials, the investment banks are doing particularly well because, of course, they're levered to a stronger market. We've been enjoying a stronger market over the last few months. A couple of things. First of all, Goldman Sachs has traditionally traded at reasonable prices, fairly high prices, because they had chunky earnings. I think that one of the things I don't like about Goldman Sachs is that they are so tied to trading and investment banking. I would prefer something that is a little bit more integrated. Frankly, if I had to choose one today, I might choose Citigroup as one that I'd be more interested in. I think you're more likely to see share buybacks and a dividend increase at some point over the next year. We're going to talk about another bank today, but I would look at more of the integrated banks than just the straight investment banks. I think, though, that as long as this market stays strong, this group is going to remain one of the stronger groups to be invested in. From a risk standpoint, obviously stop losses I think are important. I think one of the ways I'm trying to control risk is by owning something that isn't solely focused in capital markets, because I think we'll have a smoother ride in something like a Citi or a JP Morgan or a Bank of America.
Right, and there's a look at Citi, and you're going to talk more about JP Morgan in just a while. Let's shift gears. We have John in Toronto. He wants to talk uranium. Go ahead, John.
Hi, I'm John from Toronto, and I'd like to hear your long-term view of chemicals, specifically maybe out 2 years.
Right. So, John, I have to be honest, you're going out a little further than I can look into my crystal ball. Here's the way I would look at it currently. As it stands today, we are seeing an unprecedented growth in the production of both gas and oil in North America. So much so that we can't process it all, either to ship it out of the country or to use it ourselves. So obviously, Cameco does well when you have high energy prices. And I think it's very possible that for the foreseeable future, we're going to have lower than expected energy prices, which is great for some industries. But in the near term, I think it's going to be hard to make money in Cameco. Now, 2 years from now, can they start to solve this problem? I think we're going to be in a deficit of infrastructure for quite some time for the energy space. So I know that Cameco is not terribly expensive, but I think that there's better sectors. And when I look at earnings revisions, they're generally working their way lower, not higher. So energy, a difficult camp to be in. Uranium, probably a more difficult camp than even oil and gas. So I'd avoid the stock.
All right, David, here's Richard in St. Thomas, Ontario. Hi, Richard.
Hi, Mark. I'd like to ask David if, as a retired investor, he'd recommend investing into Ford or General Motors. Thank you very much.
Sure. So, Richard, I would have no problem whatsoever you buying Ford. Very strong cash flow generation. It's in a part of the market that is seeing net inflows of capital. I think that it's not terribly expensive, and realistically, you could see the dividend work its way higher. So I think that Ford is probably not a bad choice, and it's one that I've been taking a pretty hard look at, and our team has been taking a pretty hard look at in our portfolios.
Interesting. So, even though you already have auto parts makers.
Yeah, I think that. Listen, we focus and continue to add to the groups that are participating. I think that Ford is not a bad way to play it. You want to be focused right now on companies that have, outsized ability to generate cash, because that's what they can return to us as shareholders. And people are looking for income replacement. And I'd rather buy a company that pays me a 3% yield that can give me 5 or 6% dividend growth than a 10-year Treasury bond at 1.8% a year. And there's a lot of companies. Actually, just as an aside, there's 55 companies in the S&P 500 right now whose credit default swaps, or the cost to insure against default, is lower than the cost to insure against default on a Treasury bond. Yet almost all of them have dividends well in excess of a Treasury bond yield, and most of them will give you dividend growth. So that's why I think you're seeing money shift into equities, but specifically into the areas that could pay it out to the shareholders.
Right. Interesting stat. Here's Keith. He's in Edmonton. Hi, Keith.
Hi, how you doing? Great show.
Thanks.
Quick question for you regarding my underperforming Talisman. Just want to know your outlook is if this would be a sell or a hold, and given the state of the commodity prices for oil and gas, do you see Talisman maybe potentially as a takeover candidate? Thanks.
Right. So Keith, sadly, you know, Talisman is maybe one of the least liked energy companies that you could point to. And not to make a comment on their assets, it's just not a well-liked company. And so it's a laggard in a difficult group. So is it possible it could get broken up and sold? Absolutely it is. You know, activist shareholders are out there. But it's hard to make a bet on something where you're betting on that kind of catalyst. You know, there are a few oil companies and gas companies that are performing quite well. I'd suggest you take a look at a Tourmaline or a Vermilion. They're performing quite well in a difficult market. The Talisman is something for a value investor who's good at breaking up and adding up the sum of the parts. That's not our strength.
And speaking of Tourmaline, the first energy capital conference is on in New York starting tomorrow, and Jameson Burrows there. I counted, I think, 17 CEOs he's going to be interviewing, so watch out for his coverage, and if you miss any of the interviews, you can catch him on BNN. Now, as always, lots of demand for David, so let's do the Market Call Minute. Rick in Vancouver called in about Bonavista. What do you think of this company?
I'd sell it. It's a solid underperformer. They're having a very difficult time executing.
And you don't hold it?
Don't own the stock.
John in Leamington, Ontario, on Yum Brands, their China data less worse than expected.
Yeah, this is a company that we've owned in the past. Yes, the data was less bad. I will say, though, that in general, the consumer stocks that sell into China are having a difficult time. Consumer's a little bit weak. I'd avoid the stock.
Okay, David. Here's Don in Ottawa. He called in about Wells Fargo, speaking of U.S. banks.
Yeah, beneficiary of a stronger housing market. You could own it. I would prefer a Citigroup or JP Morgan.
Okay, again, you'll talk about JP Morgan in just a second. Jim's in Hamilton. Onyx has been hitting all-time highs lately. What do you think of this big conglomerate?
Listen, the conglomerates are behaving extremely well. Take a look at Berkshire Hathaway, one of our favorites. This is a way to get exposure to manufacturing in the U.S. They got a lot of companies they can spin out. I was looking at the stock today. I'd be happy to own it here.
Beautiful chart. Tweet from @Frederico Quanzo, I am gold, IMG.
Well, at the risk of angering the gold bugs, you know, and I've been a gold investor in the past, we own no golds, and we have been short for quite some time, many producers, and we've covered some recently because they've gone down a lot. I would not be a buyer.
All right, fair enough. And lastly, Don in Saskatoon, he called in about Saputo.
Saputo's a holding of ours, behaving really well. It's recently consolidated over the last 3 months. As it's breaking out here, I'd add to the stock. Consumer staples are a very strong part of the market.
Looks like it's building a nice base there. And lastly, we got a call about SNC-Lavalin.
You know, at the end of the day, reputationally, things are following them around. It's a company that I think has news risk in it. And in general, that sector, we're avoiding the big commercial construction companies.
Okay, that is the Market Call Minute. We'll take a short pause and come back with the top picks from David Burrows.